First thing I want to do is thank the planning committee. So if you're on the planning committee, could you please stand and Rich Cole, Kimberly Fiore, and Stephen Train. So thank you. We started working on this back in September, and one of the first things we had to do was go through all the submissions for keynote speech and breakout sessions. It was about 4 hours of reading before we even started to shift through it. And these guys have been there all the way, putting in all the effort to make this a success. But I would be remiss to not do a special thank you to my partner in crime, Leanne Rum, who Okay, so one of the things I've been asked to do is talk about why BISA is an important organisation for WealthVest to be part of, and I would assume for yourselves. You know, this is a relationship business that we're in. And I was just talking to somebody, and you should never say a bad word about anybody in this room because they might end up being your boss, right? And this is just the most perfect place to build relationships, but BISA provides the tools to educate as well. And if you think back to some of the sessions that we've had already this morning, the panel, every time I sit down here with somebody, I learn something. And that's why it's important to me to be a member, and why it's important for WealthVest. So when we were talking about keynote sessions and stuff like that, one of the things that came up was that economists, you could get 2 or 3 of them in a room and none of them would agree on that. And so we came up with the concept of dueling economists. However, we've got 3 people here who agreed on one thing. They're not economists, they're investment strategists. So what I would like you to do is take out your phones, go to the BISA 23 app, go to Agenda, click on this session, and up on the upper right-hand corner of the app, there's a section that says Polls. And what we're going to do is discuss some concepts and things like that, but then going to ask you what your thoughts are. And we'll see, you know, if we can build some consensus and stuff. But one thing you'll find out from these guys, they do not agree on anything other than the fact that they're not economists. So without further ado, I would like to invite Tim Pierotti, Gene Goldman, and Marc Zabicki. Tim is with WealthVest, Gene is Cetera, and just to round it off, we have Marc from LPL.
All right, this mic is on, excellent. So I'll introduce myself, and then Marc and Gene can introduce themselves. I'm Tim Pierotti. I'm fairly new to WealthVest. I just started with the company last year. My background is mostly in equities. I've spent 27 years on Wall Street. Much of that in equity research, either covering hedge funds in equity research or helping to manage equity research departments, which is what I was doing the last 7 years. I also spent 11 years of my career working in long-short hedge funds, most notably a firm called the Galleon Group, where I was the consumer sector head. I covered consumer staples, housing, and autos. But I've been basically a generalist in equities and a macro investor for most of my career. Gene?
Excellent. Well, good afternoon, everyone. So I'm Gene Goldman. I'm the Chief Investment Officer for Cetera Financial by means of introduction. I've been with Cetera now for about 11 and a half years. I moved from Boston to California. I live in California, but not California native, so please don't hold that against me. I moved to California before Cetera. I was at LPL for about 16 years, covering a variety of research roles. Before that, I worked for another broker dealer called WealthVest Financial, and then before that, I was a grad school and engineering school. Went to school for aerospace engineering. I know it seems a little strange to go from aerospace to finance, but 2 things happened. Number 1, the Cold War ended, so these jobs aren't going to be there. Number 2, I just don't like pocket protectors and short sleeve dress shirts.
Good afternoon, my name spent some time in the outsourced chief investment officer space, which is an outstanding space to be in, by the way, and been 2 years at LPL, now as the CIO.
All right, very good. So we'll get right into it, and we'll put the first question to Gene. Gene, could you discuss how you see the economic slowdown and eventual recovery playing out? And will we see a recession, and how strong of a recovery?
Sure, great question. So I've got bad news and good news. So the bad news, think about the economic scenario du jour right now. It's the whole no landing, which really means that basically no recession. And unfortunately, we do see a recession. And I think the Fed is going to drive this recession. If you look at the Fed makes mistakes. The Fed has made a ton of mistakes historically. The last 15 rate hike cycles, the Fed has pushed us into a recession. 11 of the last 15. That's a huge batting average. And the Fed is super aggressive. Think about this. Back in 2016 to 2019, it took the Fed in 3 years to go from 0 to 2.5 in the Fed funds rate. 0 to 2.5. Last year, it took the Fed 6 months to go from 0 to 2.5. Right now, we see the Fed funds rate at 4 3/4. Clearly, interest rates are extremely aggressive. So we do think the Fed is going to push us towards a recession. And we're seeing the data already. You can look at credit card usage is surged. You can look at savings rates have come down a lot. You can look at the 210 spread. The 210 spread is the bond market screaming, Fed, you've done enough. Think about the 210 spread. Go back to bond investing 101. Here's the 2-year, here's the 10-year. 2 years always below the 10-year. It's inverted, the 2 is above the 10. Historically, when this has happened, we've seen a recession within 12 to 24 months. But more importantly, think about this, a bank, okay? You're borrowing money from savers at short-term yields. You're lending out at long-term yields, mortgages, autos, whatever. The spread, you're losing money on the spread. I know there's some assumptions in there, but you're losing money on the spread. Imagine this, as this goes through all the banks. This hits the economy, this slows down because banks are not going to be making as much money as they have before. So, I know I made some assumptions, but that shows important. One thing we're looking at is the PMI, the Purchasing Manager Index. This is my favorite data indicator. And just so we're all on the same page, what this is, it's a survey of hundreds of purchasing managers all across the country, and they're asked, how's hiring, how's firing, how's business, how are new orders, all these qualitative questions, and they're squeezed together. And if the index is above 50, it's expansionary, below 50, it's contractionary. Most of the subcomponents are well below 50, contractionary phase. Again, we do worry about a recession coming very soon. The question we get from a lot of our advisors and their clients is, okay, recession maybe in 2023. When is the recession coming? When? That's a great question. We can look at 2 data points. Number one, simply, it takes about 12 to 15 months for a Fed rate hike to impact the economy, to be fully felt by the economy. Fed raised rates in March of last year. You flow through from the calendar, you're looking at maybe the second or third quarter of this year. The other data point we can look at is called the Leading Economic Index. So what this is 10 real-time, high-frequency data points, like jobless claims, like manufacturing hours worked, like building permits. It's really great data that's squeezed together. We love the LEI, the Leading Economic Index, because historically it tends to peak about 13 months in advance of a recession. This thing peaked in February of last year. Roll the calendar through, second or third quarter. So I promised you good news too. So bad news, recession. The good news is that we anticipate a very mild recession. There's 3 reasons to look at. Number one is the labor market. The labor market is so strong. You can look at jobless claims, you can look at unemployment rate, all the data looks great. But keep it simple. There's 5.5 million more jobs out there than people looking for jobs. Anyone that wants a job can get a job. Anyone that does not want a job can get a job. There are so many jobs out there. Second of all, housing is very strong. It's not like 2008. It's not going to drag us down into a recession, a deep recession. Think about this. Inventories are low. We don't have those no income verification loans. My favorite data point is, in terms of housing, is that owner's equity. Right now, owner's equity in homes, it's about 70.54%. During the 2008 housing crash, it was about 40%. We're looking at levels not seen since the early 80s. So what all this means is that housing is under pressure. It will be under pressure because the Fed is targeting this. But housing has a strong foundation, pun intended. And then the third point is a rolling recession. We anticipate a rolling recession. Quickly, what that means is that sectors under pressure right now, manufacturing, housing, autos, as they start to recover, other areas of the economy that are doing pretty well, consumer spending, loan growth, capital spending, should start to get impacted. Not everything falling at once, rolling through the economy. So bad news recession, good news expected to not.
Okay, Mark?
Sure. So I think the answer is fairly simple, and Gene, I think you touched on quite a bit of it actually. There's a couple key indicators, several of them actually, that we pay attention to very closely that are signaling to us a recession is imminent. We think it's going to be a modest recession. So Gene touched on rate spreads, which I think everybody pretty much knows, whether it's 2s or 10s, or 3 months or 10-year. Those are signaling we're going to have a recession. Perhaps more importantly, we pay close attention to the leading economic indicators, whether you look at that from a slope of the line perspective or rate of change of that indicator. It's pretty important in calling recession. Right now, the slope of that line indicates that we are going to have one. And then finally, one of the key indicators is really manufacturing, new orders, and also services, new orders, which are generally weak as well. So we think the consumer is kind of holding things up a little bit with some a treasure trove of fiscal stimulus still in their pockets. So that's one thing that's been helpful for the consumer. The jobs market's relatively strong. One of the reasons there that the jobs market is strong, we believe, is some of the reshoring and nearshoring activity that is occurring. So, given what we're seeing from a kind of a rate spreads perspective, LEI and other indicators, we think we're going to have a modest recession followed by a modest recovery. Given what's going to be a fairly strong consumer throughout, we believe, and a fairly strong, jobs market. We think the Federal Reserve has indeed done too much, and the big risk is have they overdone it to the point where that recession doesn't become modest, it becomes a little bit more impactful, but we don't think that's our base case.
Thank you, Mark. So my thoughts are, I agree with these guys. We're going to have a recession for many of the same reasons they talked about, the leading economic indicators, weakness in manufacturing, housing certainly has to come off the boil. But I do think you have to consider the possibility that it could be a fairly deep recession. Look, when all is said and done, the Fed will have moved by 500, maybe as much as 550 basis points. If you look at the senior loan officer surveys, it's telling you that credit is getting less and less available. So cost of capital is going up by a hell of a lot, and the availability of credit is going down. That strikes me as two of the ingredients that you really need in order to have a credit event. Real credit pressure at the consumer level, corporate level, and even at the dollar-denominated sovereign level. So my fear is that it could be a more difficult recession. I like to think about how we go into the downturn using the HOPE acronym, H-O-P-E. It's created by a guy named Michael Kantrowitz from Piper Sandler, but housing is in a recession. I agree with these guys on that. Housing prices are down 4%. Housing prices are up 38% since the beginning of the pandemic. That was crazy, way too much stimulus. Hell, it was only a year ago that the Fed was still buying mortgage-backed securities. So we are early days, long and variable lags, and we were in the early days of the housing recession. On orders, I agree. Manufacturing is in a recession. We got a Chicago Fed this morning, which is 43.6 on a diffusion index. That's a terrible number. All of the regional Feds are really start to converging that it's clear that we are going to have, or we are already in a manufacturing recession. What matters now is profits, though, because to get unemployment down, you got to get profits down. Well, that's happening. Fourth quarter S&P earnings are down 3.5–4%, and that's with energy up a hell of a lot. NASDAQ earnings are down about 13% in the fourth quarter. That is what you need for companies to want to say, I got to protect my margins here. We got to start to lay people off. So as strong as employment has been, I do think employment is going to be coming off the bubble, but it is the classic lagging economic indicator. In terms of the recovery, I think it's going to be kind of an L-shaped or kind of a flattish W-shaped recovery because of what I see as secular supply issues. The Fed can create demand, the Fed can destroy demand, the Fed can't create supply. And we have one really big supply problem, and that is in labor. The labor shortages that we have are not going away. And I won't go into all the details, but demographics, deglobalization, creating more demand, as you talked about, lack of legal immigration coming into the country. Obviously, I said the aging workforce as well. People want to work less. We have real weak labor force participation. So all of those things are coming in together where we are going to have a structural long-term supply issue, which I think is going to make the Fed really think twice about making the mistakes of the Volcker era, of tightening, loosening, having to tighten again. I think we're going to be a higher for longer environment, and I think that makes for a tough recovery. So now the opportunity is for everybody to submit your thoughts on on how you see the downturn and the recovery happening. Looks like the preponderance is shallow recession and shallow recovery. On that, I think that we kind of all agree. I think that is, all right, we're in consensus. That's super helpful for everybody. All right, next question. And this one will start with Mark. Could you talk about your forecast for the S&P for the year?
Yeah, so I think the question is are we going to climb the wall of worry here? We think we are. And I think that wall of worry started in mid-2022 effectively. And what I mean by that is I think the market was pricing in the greatest amount of fear in terms of the type of recession we could see. Now here we are in 2023. I think we're learning now that the recession is likely going to be more modest, and some people are even calling for no recession whatsoever. That's why we had the question prior to this one. So given that the market was oversold rather dramatically, we think we could get a lot of tailwind behind us in 2023. So we're relatively bullish on the S&P finishing the year around 4,400, 4,500. I'll get to the risk associated with that in 1 second. But the tailwind being the Federal Reserve stopping its rate hike policy, and then history shows that typically when that happens, the market does perform relatively well. That's something I think we can hang our hats on. Other calendar effects are also interesting when you think about the equity market in general. One of those is just looking back over the last, since the 1930s, let's call it. There's only been 4 times where the S&P has finished down in back-to-back years. Now, you have to do your homework, so that's just an interesting data point, but there's some calendar tailwinds behind us from a post-midterm election activity in the equity market, which is typically positive, and historically always positive, by the way. And then it's even more positive when you do get a split Congress like we saw between the Republicans and the Democrats. So there's some calendar effects that are going to be positive. We think there is just going to be improved sentiment largely based on the fact that the Federal Reserve is going to end its tightening cycle and then perhaps pause or move on. And I think now the rate cycle is not going to change perhaps until maybe late 2023 or early 24, where the Federal Reserve may maybe make it a little bit easier. So fairly bullish, but I think most of that was, the foundation for that was laid basically in mid-2022 when the market just got oversold.
Gene?
Sure, I think we're a little different. So let's start with some good and bad news. I think good news is that we expect a mild recession like 2001. I think the markets last year priced in a more aggressive recession. The S&P is down almost 20%. I think the bad news is that we expect a mild recession like 2001. And what I mean by that is that if you go back to the 2001 recession, let's think about the couple of years before. We had a huge run-up in terms of Y2K, in terms of tech spending, the tech bubble, and analysts were raising earnings estimates dramatically in anticipation of we all had to take care of Y2K, we all had to go to the pet stock